brief review of accounting. So for you accounting students, there really should be nothing new in this chapter. So I will go through this reasonably quickly and we will talk about it during our live lectures. So, you know the basic financial statements, statement of changes in equity, income statement or statement of financial position. Depends if you use IFRS or not. This book still tends to use some of the older terminology like income statement and balance sheet. It hasn't totally changed over the nomenclature or the names. So we're going to talk about the income statement, the balance sheet, the statement of cash flows, etc. Finance is about the future, and using historical information is valuable. And finance people will look at how much income is being made, what is the retained earnings of the company, which is like the net worth, the balance sheet, and obviously the retained earnings are a portion of that. And very important to finance people are cash flows. Where's our cash coming from? What source? And where's it going to? So it's a big difference as if you are receiving cash from your operations, which is positive, but if you're getting cash from bank loans, that can actually be viewed as a negative. You know the income statement, the very rudimentary version of it is simply revenues minus expenses. In this course, you need to understand the financial statements, but we're not at any point in this course ever going to talk about debits or credits, but you can use your accounting background to determine, if cash is coming in, if cash is going out, does it affect the income statement, does it affect the balance sheet? So it's more from what would be called a user perspective, not a preparer perspective, that you need to understand accounting. So you can see here's an example of statement of retained earnings. And you've done these before in your accounting classes. So this is just again, a brief review of your accounting knowledge. Earnings per share are earnings available to the common shareholders. And you simply divide it by the number of common shares outstanding. If you have, you can also have diluted, which would be the denominator would be the number of common shares, like potentially, or you can potentially issue. Then you would just change the denominator. So sometimes you'll see two, earnings per share, and then diluted, which would mean that all the shares have been issued. The payout ratio is something you don't really talk about in accounting, but what that does is a corporation makes $1 in this case. And what they do is they pay 50% or 50 cents of the dollar goes to their shareholders. And what's called the plowback ratio. So you have the two. You have the payout ratio, which is the percentage of each dollar that you earn that goes to the common shareholders. And in this particular case, the plowback ratio, which in this case is also 50%, it has to total to be 100% or 1, is what a company keeps. So in this case, they make $1, they give 50 cents to their shareholders, they keep the 50 cents. That's remaining. Now the shareholders expect the company to do something with that 50 cents. They expect them to invest in a new product, do some research, renovate buildings, or upgrade their, add inventory, whatever the company feels they can earn a higher rate of profits on. So you have two, payout ratio and plowback ratio total to be 100%. Price earnings ratio is simply the current market share price divided by the EPS. So in this case, it's 12. So what that means is for every dollar you invest, for every dollar of earnings the company has, the share price is $12. So if the earnings per share jump to $2 from the current one, the share price will double and it'll go from 12 to 24. So It's very much like a multiplier that you took in economics. So every dollar of extra earnings per share have a $12 effect on the market share price. Now this goes in a positive way and a negative way. So if the earnings go down, you have a 12 times effect on the market share price. So if the earnings went down by 50 cents, your share price would go down by $6. The dividend yield. What kind of rates of return are we getting on our monies? You invest $12. The corporation, because they have a 50% payout ratio, gives you a dividend for 50 cents. So you simply divide the return, which is the dividends per share, and you divide it by how much money you invested, the $12. And you can see in this case, it's just slightly more than 4%, 4.17 to be exact. That will tell you how much return you receive from dividends. You will also get a return from if the share price goes up. So the income statement is good, but accounting is about the past. So how much money you made last year is not, it is and is not that important to finance people. It may give an indication of the future, but when you buy a share in a company on a particular day, you're not buying past profits. Those monies have been paid and were paid out to the past owners. What you're interested in, how much money is the company going to make in the future? So finance is futuristic. It doesn't care about the share price 10 minutes ago. It cares about the share price now. And more importantly, what's the share price going to be 10 minutes into the future, 10 days into the future, 10 years into the future? So finance is like looking out the front windshield of your car. Accounting is like looking in the rear view mirror. And they both have their place. The balance sheet, as you're well aware, tells you the assets and the liabilities and the net worth / equity portion of it. And it simply is based on cost. Finance is very much based on not cost, current market values. That's one of the major differences between accounting and finance. Now, under IFRS, there's been a major shift from much more of a cost-based accounting system, which was a major criticism of the way accounting was done before Canada went to IFRS. And now there's much more of a shift on what is it currently worth. So for example, one of your accounting instructors told me one day he did work for the City of Calgary. City of Calgary bought a piece of land in downtown Calgary in approximately 1920 for like $5,000. Well, it was still on the books for $5,000. And as you're aware, land does not depreciate, so it sits on the books for $5,000. That piece of land, I have no idea what the cost is, so I do, sorry, $5,000, but I have no idea what the current value is. That piece of land could be worth hundreds of thousands, if not millions of dollars. And his argument to them was that's not a fair representation of the value of the asset. You need to adjust for that. Under previous accounting methodologies, you couldn't. Under IFRS, you are encouraged to make it more realistic, make it more current, using market values. So you're all familiar with this, the classifications of the balance sheet, assets, liabilities, equity. You took this way back in your intro accounting course. You know a current asset, a current liability. You know capital assets, which are sometimes called PPE, plant, property, and equipment, or fixed assets, or long-term assets. They seem to change the names. I will typically call them capital assets. They last more than a year. And current and long-term liabilities. So these classifications, there's 5 of them. These under current assets and capital assets, etc. These are important to understand for finance. because we also are very much focused on, is it a short-term, loan, or is it a long-term loan? Big differences. So the balance sheet, again, has been recorded at historical cost, and something bought in 1920, a piece of land, like my example earlier, is not really that relevant to current prices. It may be, it may not be. I've seen lots of examples of that in my career. A company I worked for had a dam that they built in the late 1920s. And of course, they had upgraded it, but they'd also depreciated the dam. And they wound up selling the dam for $63 million. And it was on the books for $3 million. So they had a gain of $60 million. But the real value of the dam was $63 million, not 3. So that makes a huge distortion in your balance sheet. And why our IFRS is much more based on market values. Income and cash flows, as you're well aware, just because a company made money does not mean that they have positive cash flows, because cash can go out of your company to buy new equipment, to hire new people, things along that line. And so net income is not the same as a cash inflow. You can even have a loss and have a positive cash inflow because of depreciation. So finance managers are very focused on cash flows. They're also very focused on risk. So as I mentioned, it's my 2 favorite 4-letter words are cash and risk, because I'm a finance instructor. So it fits, and they're very important. I pay attention to my cash flows, my cash inflows, and my cash outflows. You do too. You have a pretty good idea, like I said, how much cash you currently have. You have a very good idea, or probably a good idea, how much cash you'll have next week at this time, a month from now, etc. It's very important for a business to track it. When I worked in accounting as their finance person, I did cash flow projections for 2 months. 2 months into the future, I would have spreadsheets and update it literally on a daily basis as to our cash flow projections. And by doing that, I prevented the company from going bankrupt. Because 2 months before we were going to be bankrupt, I told the owner, I said, in 2 months, you're going to be bankrupt. We need to make some changes now. Otherwise, you're going to have a big minus sign in front of your bank account. And we used up our line of credit. We were like maxed out on our credit cards. We had no other sources of cash. So either payroll was going to bounce, which is a bad thing for all employees, or we need to make some changes. And even on a personal basis, I have a cash flow projection spreadsheet that I do for anywhere from 1 to 2 years down the road, just to see where I'm at, how much money is coming in, how much money is going out. And I update that whenever there's a change. Probably in a month, I'll update it 10, 15 times to give me a sense of where I am with my money and how much money I have and how much money I'm going to have next paycheck, the paycheck after, some of the bills that I have to pay, etc. So in this case, you get cash from your operations, cash from financing, and you also get cash from investing activities. And it can be an increase or a decrease. You've done these before in your accounting classes, so I'm not going to go through it in great detail. Like I said, this is just a refresher on accounting. And it is important to understand, though, that cash flows from operating are viewed as a very positive type of thing. Usually investing is a negative cash flow because you're replacing an old truck with a new truck. Of course, the new truck is more expensive than the old truck. So you'll have a cash outflows from that normally. And then, of course, from financing activities, the sale of common stock and preferred stock and and things along bonds, etc. All right. So this is just a bit of a summary of what I just mentioned. And once again, cash, cash, cash. Cash is king, cash is queen. Cash rules. If you don't have cash, you're out of business. Corporations do not go bankrupt because they lost money. Corporations go bankrupt because they do not have sufficient cash to pay their bills as they come due. I know somebody who had a very expensive home, well over $1 million, but they were on the verge of bankruptcy because in that particular case, they didn't have any cash. They were like house rich and cash poor. And you need liquidity. Liquidity is the ability to pay your bills as they come due. And you as students realize that very well, that you need cash to pay for your tuition, your books, your food, your transportation, on and on. There's like an endless list of expenses, and you have to be very careful with your cash flows. So do corporations. So you do finance on a personal basis. Thank you for listening. That's the end of chapter number 2.